Okay, good evening, everyone. Good evening, Kiran. Good evening, Bhumika. Good evening, Rajiv, Darshan, Sundar. Very good evening to all of you. Welcome back to my session on financial management. And today we are going to take up a interesting topic in the interesting subject of financial management. Uh, so we are looking at the topic today, which is about financing decisions, uh, which talking about the capital structure, financing decisions, capital structure. Now, this topic, we're going to divide it into two parts. Uh, One is going to be today's session, and the other one is going to be on the Tuesday session, I suppose, in which we'll be looking at some capital structure theories. But today we are going to do some sort of calculation and some new concepts we are going to learn. And let me just introduce this topic to you with the help of a simple example. Now, suppose we have to raise some amount of capital. So let's say funds to be raised. Funds to be raised is 10 lakh. So we have a total amount of 10 lakh to be raised, right? Uh, Now, in order to get these funds from the market, I have multiple options. So we have plan 1, we have plan 2, and plan 3. We have multiple options. So first plan, uh, let us say we are planning to raise this 10 lakh entirely by way of equity funds. So we have this plan 1. We are going to raise the funds by way of equity shares with a face value of, let's say, 10. So with a face value of 10 lakh, I'll raise this entire money of 10 lakh by way of equity shares. That's the first plan. Now the second plan is to raise this funds. The second plan is to raise these funds again by way of some portion of equity and some portion as debt. So let's say we are planning to raise this 10 lakh first by 5 lakh of equity, and the balance 5 lakh by way of debenture. Balance 5 lakh by way of debenture, costing us 10%. Okay. So the rate of interest on these debentures is 10%. Now the third plan is to raise the funds by 3 sources: equity, debenture, and preference shares. Equity is 2 lakh. Debentures are 4 lakh. Let's say, and the balance 4 lakh are raised by way of preference shares. The balance 4 lakh is raised by way of preference shares. Okay. So in this way, the total funds that we're raising is 10 lakh. So these are the 3 plans that we have for us. The 3 plans through which we are going to raise the funds. Okay. 3 plans, 10 lakh, 10 lakh, 10 lakh. But the way in which we are going to raise the funds is different because the capital structure of this 10 lakh is different, right? So capital structure is a bit different. Okay. So the first plan that we say is, fully equity. The first plan that we say is fully equity. Second plan is, equity and debt. Third plan is comprised of equity, debt, and preference shares. So these are the 3 separate plans that we have. Now, what separation do we have across the plans? Well, we have the separation in the form of uh, in the form of the capital structure. Okay, we are unable to view your writing. Is it? Okay. So I think now it's visible, guys. So we have these three plans. I think it's visible to you now. Yeah, there was some technical glitch, guys. So I just try to reconnect and I think everything's good now, right? Okay, so we have got three plans. All the three plans are differing by with respect to the capital structure, with respect to the capital structure that we have. So of course, what we can observe over here is that the plan one is a all equity, whereas plan three is having the highest level of capital gearing or the leverage in the form of, borrowed funds are to a larger extent. Now, how do we decide which of these plans should be used for raising of funds? How do we go ahead with the decision of which plan to be which option or which plan to be chosen for raising the funds? Now, for that, let me just take you a bit ahead and let's talk about the EBIT first. That's earnings before interest and tax. Now tell me guys, is the earnings before interest and tax going to be different? Is the earnings before interest and tax going to be different for each of these plans? Of course, no, because EBIT is a operating income, and that shouldn't be differentiating factor for the three plans. So EBIT should be ideally constant whichever way you raise the money, because ultimately after EBIT the financing role comes into play. So till EBIT, from wherever you get the fund, the business is going to operate in a similar way, and your EBIT is going to be same across all the plans. So if you look at EBIT, we have 3 lakh in each case. So 3 lakh in each case. From that, we'll subtract the interest, and that interest amount is of course going to be nil in case of first plan, and in case of second plan, that's 50,000, and in case of third plan, that's 40,000, right? And we have the profit before tax of 3 lakh. In the second plan, we'll have a profit before tax of 2 lakh 50. And in the third plan, we'll have a profit before tax figure of 2 lakh 60,000, right? Okay. Now, from that, obviously, we are going to pay some taxes also. So let's say tax at the rate of 30%. That works out to be 90,000. Then over here, 30% will be 75,000. And in the last case, it is 78,000. And that will give us a profit after tax of 2 lakh 10,000, 1 lakh 75,000, and 1 lakh 82,000 as a profit after tax. Now tell me, by looking at this profit after tax figure, can I decide which plan should be chosen? No, sir, you cannot look at it and simply decide which plan is to be chosen, because one more expenditure is yet to be subtracted, and that's your preference dividend. So preference dividend, we don't have anything in in the first two cases. In the second plan, also there's nothing. But in the third plan, we do have a preference shares. And let's say the preference shares are costing us 12%, which is quite obvious. Preference shares will require a higher rate of return. So preference shares, we can say that it's 12%. So 12% of 4 lakh, that works out to be 48,000. And then we have this net profit for equity shareholders. Net profit for equity shareholders is 2,10,000, 1,75,000, and this will be 1,34,000. Now, can you tell me, by looking at the net profit for equity shareholder, which plan is a better option, or which plan is a better choice for raising of funds? Which plan is a better choice for raising of funds? Of course, you can't decide just by the net profit for equity shares, because you need to compute how much profit you are earning for each shareholder. Okay, so for each shareholder, how much profit you are generating, that is what's more important. So we'll say divide this net profit for equity shareholders by number of equity shares, which is 1 lakh in the first case. In the second case, it's 5 lakh divided by a face value of 10. So that's like 50,000. And here we have this as 20,000. Right. So this is giving us the earnings per share. So earnings per share is, this is 2.1. 1,75,000 divided by 50,000 will give us 3.5. 1,34,000 divided by 20 is 6.7. So as per this rule, as per the EPS, the last plan is actually providing us a greater degree. It is providing a greater degree of earnings per share. So each shareholder is getting a higher amount of earnings per share, and that's where this plan makes wins in this typical race. However, as we have seen in the first chapter, it's not the profit maximization which should be the goal of a finance manager. A finance manager should not be considered, should not be considering only how to maximize the profit, but rather it should look at wealth maximization or wealth creation. Now, how do we go about creating wealth? How do we go about creating wealth? So for that, we'll have to compute the market price. Now tell me, under each of these plans, plan 1, 2, and 3, which plan is going to give a more confidence, a greater degree of confidence to the equity shareholders? Out of these 3 plans, which plan is going to provide a greater degree of confidence to the equity shareholders? Is it plan 1, plan 2, or plan 3? Which plan is going to provide a greater degree of confidence? Yeah. Which plan is going to provide a greater degree of confidence? Or which plan has got a lesser amount of risk, rather? Because lesser risk means greater confidence. It is quite obvious the plan 1, guys. Because the first plan involves raising funds by way of only equity shares. In first plan, you're raising the funds by way of only equity shares. So when you are going to have all the funds raised by equity shares, it means there is no debt obligation on the company. There isn't any preference dividend obligation on the company, and that increases the confidence of equity shareholders because they don't see much risk in it. And therefore, plan 1, plan 1 is the one, where the shareholders are going to have a greater degree of confidence. And that for that reason, if I want to decide what should be the PE, which will be generally given, tell me, since plan 1 is going to provide a greater degree of confidence to shareholders, out of these 3 plans, which plan is going to have the highest PE ratio and which plan is going to have the lowest PE ratio? Tell me, guys, which plan is going to have a highest PE ratio and which plan is going to have a lowest PE ratio? Yeah. Right. So which plan is having the highest PE ratio? See, PE ratio, price to earnings ratio, it was indication of the confidence, right? So higher the PE ratio, higher is the confidence, and therefore we can say plan 1 is typically going to have a greater degree of confidence. So let's say this gives a PE of 12. Second plan is a bit risky, which is like 50-50. So we can say if it's risky, then the P ratio can work out to be uh, maybe let's say 11. And plan 3 is extremely risky, sir, because it's just 2 lakh of equity, whereas the balance are from the borrowed funds. And therefore, this is going to be 5. P ratio given is, let's say 5. And if we just compute the MPS, market price per share, I hope you recall this formula of P. So P was market price per share upon earnings per share. Therefore, market price per share will be P multiplied by EPS, right? So if you just multiply the EPS with P, what's the market price that we are getting? What's the market price that we're getting? So 12 into 2.1, that's 25.2. Whereas in the second case, the PE is 11, that's going to give us 38.5. And the last case is 33.5. So as per the NPS criteria, if you look at the overall wealth of the shareholders, we can say wealth-wise, it is the plan 2, which is a better choice for raising funds because that's going to provide a greater degree of confidence to the equity shareholders. Or, also it's balancing actually the confidence of equity shareholder and also the earnings. And therefore, if market price per share is to be taken a criteria, it should be plan 2. Okay. So how to decide which financing plan to be chosen, guys? How are we going to decide which financing plan is to be chosen? So the point is the financing plan with highest EPS to be chosen. The financing plan with highest EPS to be chosen. And if P ratio is given, then plan with highest market price per share. Then a plan with highest market price per share should be chosen. Right? So the whole point is highest EPS criteria or highest MPS criteria. Now, when we look at highest MPS, of course, when the P ratio numbers are given to us. Okay, so this is the rule of thumb that we're going to follow while selecting the financing plans. Okay, so while selecting the financing plans, we're going to follow this rule, in which the plans are going to be decided in this pattern. I hope it is clear to everyone. Is this fundamental clear to everyone? Yeah. Okay, perfect, guys. Great. Now, let's look at question number 2 from the handout which I have uploaded on portal. You can find this question over there. Yeah, you can find this question on the portal. Just try to look at it and we'll be solving it for our purpose. So what we have is the existing capital structure of XYZ is as under. So the existing capital structure, we have got equity shares of rupees 100 each, 40 lakhs. Retained earnings, 10 lakhs, 9% preference shares, 25 lakh, 7% debentures of 25 lakhs. So existing capital structure is comprising of total 1 crore, right? Ms. Goma is asking, sir, that means MPS is a given preference to choose right plan. Correct? Yes, Goma, right. If EPS is not given, then best plan is maximum EPS. If it does, then maximum MPS. Yes, Himanshu? If EPS, it's not EPS, if PE ratio. If PE ratio, price to earnings is not given, then maximum EPS will be the criteria. If price to earnings ratio is given, then you will have the maximum MPS as the criteria. Okay. Now, so we have to look at this question in which we have this capital structure to be of 10 lakh. Sorry, 1 crore is the total capital structure that we have. The existing rate of return on the company's capital is 12%, and the income tax rate is 50%. Okay, the company requires a sum of 25 lakhs. So company is needing additional 25 lakh to finance its expansion program. Okay, for which it is considering the following alternatives. Issue of 20,000 equity shares at a premium of rupees 25 per share. So first option is to issue 20,000 equity shares at a premium of 25. Now, when we say premium of 25, it means at a price of 125 each. At a price of 125 each, so 125 into 20,000. Issue of 10% preference shares and issue of 8% debentures. It is estimated that price earning ratio in case of equity, preference, and debenture financing would be 20, 17, and 16 respectively. So P ratio is given. So what's the criteria for choosing the plan? It's going to be the MPS, right? It is estimated that price to earning ratio is given. Which of the above alternative would you consider to be the best? And give reason for your choice in A above. Okay, so we have to decide which plan is to be chosen based on the given numbers. Now, let me just do it in a more intuitive way on Excel itself, because visually also it's going to be quite appealing. So just give me a moment while I'll just put up the Excel on the screen. Okay, just give me a moment. Okay, I think you'll be able to see the Excel right now. Yeah, let me just attach this question on the screen so that I can refer it again and again. Or I can just open up like this. There's no problem at all. Yeah, you can open it up like this. Yes, screen is visible. Perfect, fine. So let's look at this typical question. So what we have in this question is there is some existing capital that we have got, and we are looking for raising some new sort of capital. Okay, so in this case, we have got three plans. So plan one, plan 2 and plan 3. Okay. So we have this. Plan 1 is a fully equity. Plan 2 is to raise by way of 10% preference share capital. And plan 3 is 8% debenture. Okay, so plan 1 equity, plan 2 is 10% preference share capital, and plan 3 is 8% debenture. So we have the equity share capital. Now, in the first plan, by which you're raising funds by way of equity, remember this is basically done by way of two means. In plan 2 and plan 3, in both these plans, you see we don't have any additional equity shares. So whatever equity shares we have for the earlier thing, that is 40 lakh, that's going to continue in plan 2 and plan 3. So in plan 2 and plan 3, so the equity amount is going to be 40 lakh itself. Okay, let me just make them a bit realistic with certain numbers. Yeah. So plan 3 is also going to have the equity share capital as 40 lakh. What about plan 1 equity? Is the plan 1 equity going to be continuing at 40 lakh? Of course not. Rather, plan 1 equity share capital is going to increase because we are issuing certain shares. In the question, we have the first option as issue of 20,000 equity shares at a premium of rupees 25 per share. So how many shares are issued? 20,000 shares are issued. So this equity share capital will actually be comprising of 40 lakh plus we are issuing 20,000 shares, right? So 20,000 shares, 20,000 shares multiplied by 100 each. So 40 lakhs plus 20,000 shares multiplied by 100 each. So that works out to be like how much? 60 lakhs, right? So 60 lakh is the amount of equity share capital in plan 1 because we are raising the funds by way of equity share capital and 20,000 shares are issued. Now, the second thing, reserves. In both the plans, reserves will continue at the same level at which the original reserves are, which is amounting to 10 lakh, right? So for second plan and the third plan, will have the same amount of reserves. Whereas in plan 1, now the reserves are going to change because in plan 1, you have issued equity shares by way of premium of 25. So that premium will add to your securities premium. So this is actually 10 lakhs plus 20,000 shares multiplied by 25 each, right? So this amounts to what? 25 into 2, so 5 lakhs. So that's like 15 lakh. 15 lakh is the amount of reserves. Then originally the company has 9% preference shares and 7% debentures. So let's say 9% preference shares, and also company has issued earlier 7% debentures. 7% debentures. So 9% preference shares of 25 lakh and 7% debentures also of 25 lakh. In plan 2 and plan 3, Both of them are going to be there. What is going to be different is, in plan 2, the preference shares additionally have been issued. So 10% preference shares have been issued. Now 10% preference share have been issued in second plan to the tune of 25 lakh. Because that's the amount of preference shares that we needed, or amount of preference shares that we needed, and there's no preference share in third plan. In third plan, here you're seeing additional category of debentures, which is 8% debentures, which is 25 lakh. So if you consider the total capital employed, which is simply the addition of equity share capital, reserves, preference share, and the debt. And the total capital remains same in all the three plans, which is to the tune of 1 crore 25 lakh. It is to the tune of 1 crore 25 lakh. The total capital employed is 1 crore 25 lakh. Okay. Now, that's the capital employed portion, or this table is basically about the capital employed part. Now, how do we decide which plan is to be chosen for selection? We have to begin our analysis with the EBIT. So let's say we start with earnings before interest and tax. From that, we are going to reduce the interest, right? Interest, and then you'll have the profit before tax. Then you have the tax. Then you get the profit after tax, less preference dividend. Again, in case of preference dividend, you have two sort of preference dividends, and then finally you have the net profit for equity shareholders, which you are going to divide it by number of equity shares to get the EPS. And then from EPS, you are going to multiply it further by the PE ratio to get the market price per share. Okay, so we begin with EBIT. Now for EBIT, the question tells us that the existing rate of return on company's capital is 12%, right? So existing rate of return on company's capital is 12%. So whatever is your capital, and the income tax rate is 50%. So whatever investment you make into the business, you actually earn 12% of that. And over here, if you say, so we are having a total capital employed of 1 crore 25 lakh. On that, we are essentially earning 12%, which is 15 lakhs. So EBIT of 15 lakh is going to be the number for all the three cases. Now, if I want to subtract the interest, we have got two sort of debentures on which the interest is to be paid. The first interest is on the 7% debentures, and the second interest is going to be on the 8% debentures. Now, of course, we don't have both the debentures in all types of plan. In the first type, what we have is, debenture interest of 25 lakh into 7%. This into 7% plus, if there's any 8% debenture, then on that, you'll have the 8% figure. Okay, so we have this 7% debenture, and this next is the 8% debenture. So if we consider that, total debenture interest we have is going to be different in all the three cases. Now, of course, these numbers are supposed to be the negative ones, right? Now, this is 8%. Yeah. Okay. So after subtracting that, we get the profit before tax, which is simply summation of the three, that is EBIT as reduced by the interest amount. Now from this PBT, we need to subtract the tax figures. Now taxation rate is given to us in the question to be 50%, right? So tax rate is like 50%. So tax rate 50%, it means 13 lakh 25 multiplied by 50%. And then the PAT figure is after subtracting the tax from the PBT. We get the PAT as 13 lakh 25 minus the tax amount. And here we get this as the profit after tax figure. Now from that, we are going to reduce the preference dividend. Now preference dividend is 9% of or 9% preference share capital. And we also have one more preference share capital in one of the cases, which is a 10% preference share capital. So 9% preference share will be this 25 lakh multiplied by 9%. And the second case is this multiplied by 10%. So I can just subtract them, right? Okay, so here we have the preference dividend amount also. And then after subtracting the preference dividend, we get the net profit for equity shareholders, which is PAT plus preference dividends. Right, so net profit for equity shareholders is 4,37,500, 187,500, 337,500. Number of equity shares, we have the number of equity shares to be, dependent on the equity share capital, which is 60 lakh. Now 60 lakh divided by 100 is the number of equity shares, the share capital divided by 100, because 100 is the face value. Now this is of course normal number of equity shares. So we have this number of equity shares, and then earnings per share, we can get it as net profit for equity shareholders divided by the number of equity shares. So EPS is the one. Now, if had it been that EPS is the criteria for choosing the financing plans, then we would have considered this as, or again, say the first plan would have been given a due consideration. I just do it. Yeah, these are your EPS figures. But since we have been given the PE ratio, right? So we have the information about the PE ratio. The PE ratio for the first plan is first, second, and third plan is 20, 17, and 16. That's like 20, 17, and 16. Right. So NPS is going to be the earnings per share multiplied by PE ratio. So that's your market price per share. And here we have the market price per share as 145.83, 79.69, and 135.0. So of course, the but natural choice for choosing of plans will be the first plan, because that's the plan wherein we have this the highest possible market price per share. So we can, in conclusion, we can say funds should be raised by issuing equity shares, right? As it will lead to maximum market price per share. The funds should be raised by issuing equity shares as it will lead to maximum market price per share. Okay, so this was the next part of the question in which we're supposed to calculate the market price and decide which one is the best one for us. Is this question clear to everyone? Is this question clear to everyone? Are we good with it? Are we good with it? Yes or no, guys? Yeah, understood. Absolutely. Yeah. Shubham is asking which one is a reliable EPS or MPS? Shubham, it is the MPS perspective which is more reliable if you have the P ratio available with you. If you've got the P ratio available with you, always calculate the market price per share and then uh, decide which plan is to be chosen. Okay, fine. So that was question number two for us. Now after this question number two, let's go for one more question before we go for the next concept. And that next question is basically the question number three from the sheet. Let's go through question number three. Let's look at this question number three, guys. XY Limited provides you with the following figures. XY Limited provides you with the following figures. EBIT of 2,60,000, less interest on debentures at 12%, 60,000, profit before tax of 2 lakh, less income tax at 50% is 1 lakh, profit after tax of 1 lakh. Number of equity shares of rupees 10 each is 40,000. Earnings per share of 2.5 and ruling market price is 25, which is giving us a P ratio of 10. So currently we have this figures EBIT, interest, PBT till your P ratio. Company has undistributed reserves of 6 lakh. So as of now, the company is having undistributed reserve of 6 lakh. Company needs 2 lakh for expansion. This amount will earn at the same rate as the funds already employed. You are informed that a debt equity ratio, which is a debt to total capital, higher than 35% will push the PE ratio down to 8 and raise the interest rate on additional amount borrowed to 14%. You are required to ascertain the probable price of the share. So the probable price of the share needs to be computed. If additional funds are raised as debt or if the amount is raised by issuing equity shares. So we've got two options, either to raise it by way of equity or by way of debt. Now, before we go about this, deciding which plan is to be chosen, I need to look at, what is my existing or current capital structure. So let's look at the current capital structure. Now, current capital structure, we have equity share capital, equity share capital. Then we have the reserves, then we have the debentures. So equity share capital is, as of now, the equity share capital that we have. How do we get that equity share capital? You can see the number of equity shares of rupees 10 each, and 40,000 is the count of shares. So the equity share capital is 10 multiplied by 40,000, which is 40,000 multiplied by 10, which is 4 lakh. The reserves of 6 lakh, right? Because that's there in the question. It has got undistributed reserves of 6 lakh. And then you look at the debentures. Debentures is basically what you can get from the interest. So interest on debentures at 12%. So interest amount is 60,000. So debentures is going to be 60,000 divided by the 12% interest. So this works out to be like 60,000 divided by 12%. And we have the total capital employed as total capital employed as 15 lakh. Now on this capital employed, what is the EBIT that we are earning? We are earning a EBIT of 2,60,000. The 2,60,000 is earned on 15 lakhs. So the current ROCE, current return on capital employed, will be simply your EBIT divided by the total capital employed, which is EBIT upon total capital employed multiplied by 100. Right? So this should essentially work out as EBIT is how much? 2,60,000, right? So we have like 2,60,000 divided by 15 lakh. So current ROC, return on capital employed in terms of percentage, is 17.33%. So we are earning right now 17.33%, right? 17.33% is the rate of return that we are generating. Now, the question further says that the company is requiring this additional 2 lakh, and this additional 2 lakh is going to be raised by way of either debt or equity. Now, if you raise it by way of debt, it may be 12% or 14%, or that depends on this debt to capital ratio. So I need to look at the proposed capital structure and then decide what will be the applicable rate of interest. Right? What will be applicable rate of interest? So let us say the plans that we are looking at. So we have got plan 1, we have got plan 2. Now, plan 1 and plan 2, under that, first we'll talk of equity share capital. Equity share capital to the tune of, let's say the first plan, let us take it to be comprising of debt, and the second plan is of equity, right? First plan is of debt and second plan is of equity. Now, equity share capital in case of first plan, since it is debt, originally whatever equity you had, that's going to remain. And of course, we'll have the reserves and the debentures also. So debentures, which is the old debentures, and this is going to be the new set of debentures. So reserves will continue to be 6 lakh, and the debentures old one is going to be 5 lakh, and the new debentures if you're raising it by way of 2 lakh, we'll have to see what is happening to the total capital employed over here. If we have a look at it over here, the total capital employed is simply summation of all four of them, which is 17 lakh. Now, plan 2, which is a equity plan. Over here, the equity share capital will continue to be this 4 lakh and also additional equity. Now, additional equity is going to be raised in what part, in what ratio? You can say by way of equity, if you're going to issue it, ruling market price is 25, and the amount will, you can say, the question further says, the company needs this 2 lakh for expansion. We'll earn the same rate of interest. You are informed that debt equity ratio, if it is higher than 35%, then there will be something happening to the rate of interest and the PE ratio. And nothing is specified about, at what rate the shares are going to be issued. The new shares, at what rate are they going to be issued? So what assumption can I make? The simple assumption that we can make is the additional funds of 2 lakh, if they are going to be raised by way of equity, I can actually sell them in the market at the ruling market price, whatever is the existing market price. At that rate, I can sell the equity shares. So which is going to be like this 4 lakh plus additional shares that we have. So funds to be raised will be 2 lakh and each of those funds are having the shares are having a market price of 25 as given in the question. So what will be the number of equity shares to be issued, which is 2 lakh divided by 25, which is 8,000 shares, right? Now this 8,000 shares will contribute to equity share capital to what tune? 8,000 multiplied by 10. And what about the securities premium? Securities premium will be 8,000 multiplied by 25 minus 10, which is 1,20,000, right? So essentially, my new equity share capital will be this 4 lakh plus equity share capital of 80,000. And the reserves are going to be the older reserves of 6 lakh plus securities premium of 1,20,000. So reserves will be 7,20,000. The debentures will continue the same, and you are not going to have any sort of new debenture. Right? And the total capital employed will continue to be 17 lakh. Now I need to decide what is the rate, because over here, the older debentures were costing me 12%. Right? So older debentures were actually costing me 12%. Similarly, I need to decide what will be the cost of the new debentures. So now for that purpose, I need to get a ratio of debt to total capital employed. In the question, they're saying debt to total capital employed ratio. If it is higher than 35%, then this will lead to increase in your rate of interest and also the EBIT portion and all, right? So debt to total capital employed, we can say it is, the ratio is simply, the total debt, which is sum of these two, divided by a total capital of 17 lakh. So here we have these as the number. So debt to ratio, this comes out to be 7 lakh divided by 17 lakh. And if you look at it in the percentage term, that's 41.18% and 29.41%. right? So 41.18% and 29.41%. So here we have this debt equity thing, and for this 41%, now your debenture is going to be costing you 14%, right? Because this, the debt to total capital ratio is actually increasing. And for that reason, this is going to be 14% since this is greater than 35%, right? And also, since it is greater than 35%, the P ratio is going to change. So applicable P ratio for the plan one, P ratio will be 8, and over here the P ratio will be 10. P ratio will be 8, P ratio will be 10, right? Because this is less than 35%. So this will continue to be at 10 itself. We have EBIT, less interest, so you get profit before tax. Then you have less tax, you get profit after tax. Then we have this number of equity shares, EPS, P ratio, and then finally the market price. What will be the EBIT? EBIT will be 17 lakh is the capital employed, and we have seen that current return on capital employed is 17.33%. So EBIT is going to be this 17 lakh multiplied by the ROCE of 17.33%. Right? So EBIT is going to remain same irrespective of whatever plan you choose, because that is simply going to be the the simple number that your EBIT is not going to be affected by the capital employed. Now, less interest is going to be 5 lakh. On this 5 lakh, you're going to pay 12%. And in addition to that, on this 2 lakh, you're going to pay 14%. Right? And the interest in the second plan is going to be 60,000, correct? Now for PBT, it's going to be, of course, the EBIT minus the interest. So we have the PBT as these two figures, less taxation. Now, what's the tax rate applicable in the question? What's the tax rate? Tax rate is, it's given as 50%, right? So taxation rate is 50%. So let's just apply 50% tax rate to both, and we get a PAT. PBT plus a tax rate of this. Number of equity shares will be over here 4 lakh, and each share is having a face value of 10. So 4 lakh divided by 10. Right? So this is the number of shares. And the EPS that we'll have is the PAT divided by the number of equity shares. And if you look at the P ratio, applicable P ratio, we have taken it as 8 and 10. And market price per share will be simply your EPS multiplied by the market price per share. So 24.44 and 20.67 is the market price. So now can you tell me which plan should I choose? Should I be choosing the plan one, which is a debt plan, or plan two, which is a equity plan? Yeah, true. Which one is the correct plan? Of course, the plan two is going to be the better plan. So plan two is to be used for raising the funds. Correct? The equity plan. Plan two, which is equity is to be raised for is for raising the plan, raising the funds, right? Okay, so we have got these two questions done right now. This is about deciding which plan is to be chosen. And for that, how do we go about preparing an income statement? How do we go about preparing a income statement based on which you look at the plan which is having the highest market price per share. EPS is a criteria if P ratio is not given, whereas if P ratio is given, then we need to look at the market price per share. Okay, I hope we are clear till now, everyone. Are we all good with it? Yes. I hope we're able to understand both question 2 and 3 till now. Perfectly fine. Okay. So right now, I wish to start with a new, uh, with a new concept. Darshan is asking, let me see if there are queries. Darshan is asking, EBIT is determined using ROC. Yes, Darshan, you're right. EBIT will be determined using the ROC. Okay. Now we have to look at the new concept of break-even point, financial break-even point. But the thing is, it will take a substantial amount of time to get it done. Or rather, I wish to discuss that concept right now. After that, we'll think of taking of a break. Okay. Or shall we take a break now? What should be your take on it? Yeah, tell me. Shall we take a break or do one more concept and that will be like half an hour concept for the discussion? So, take. Okay, then let's do one thing. Let's take a break right now. Okay, no. Students are asking, let's discuss the concept. Okay, fine, great. I like it. Let's go ahead and discuss the concept first, and then we'll go for a break-even point. Okay, then we'll go for a break rather. So after break-even point, we will go for a break. So we're talking of something called as break-even point. Now, can you tell me what do you understand by this break-even point? What do you understand by this break-even point, guys? What's your take on break-even point? What do you understand by break-even point? Yeah, I hope you might have heard this concept of break-even point. So can you tell me what is a break-even point? No profit, no loss situation. Okay. But rather, what should be your answer? Break-even point is basically the sales at which profit is equal to zero. Sales at which profit is equal to zero, or it is the level of sales, it is the amount of units that you need to sell, which will give you a financial break-even point. Financial break-even point. What is the financial break-even point, guys? Just as the break-even point is the sales at which your profit is zero, the financial break-even point is basically level of EBIT at which net profit for equity shareholders is equal to zero. To understand this simple concept, that level of EBIT at which your net profit for equity shareholders is zero. So financial break-even point is the level of EBIT at which net profit for equity shareholders is zero. Fine. Now, how do we know that it's going to be it's the EBIT at which your net profit is zero? Let me just put a question in front of you. Let's say we have a EBIT of 35,000. Okay. From that, we are going to reduce, suppose, interest. So interest is, let's say, 10,000, which is being paid. So that will give you a profit before tax of 35,000 plus 10,000. Right? So PBT is 25,000. From that, we are going to pay tax. Let's say taxation is happening at the rate of 40%. Right? So 25,000 multiplied by 40%. That's your 10,000 is the tax amount. And then we have profit after tax as 25,000 plus 10,000, which is 15,000. And net profit for equity shareholders is to be computed after obviously deducting the preference dividend. So let's say preference dividend that you're paying is 15,000, and what you can say is that PAT plus the preference dividend of zero. So net profit for equity shareholders is zero. So EBIT is 35 lakh, interest, PBT, tax, PAT, and then preference dividend. So we have the net profit for equity shareholders as zero. Okay. So we have this full schedule available with us. So here we can say that 35,000 is essentially the break even point, or this is your financial break even point, because that is causing you to have a net profit for equity shareholders to be zero. Now, suppose if this financial break even point or this 35,000 wouldn't have been the case, 35,000 wouldn't have been the number, and you want the financial break even point. So at 35,000, we get net profit for equity shareholders as zero. What if my EBIT level is more than 35 or less than 35? So I can simply put up a chart over here. Let me just draw up a chart for you. 35,000, and we'll have numbers which are less than 35,000 also. So let's say just cut it, put it over here maybe. At some other level of EBIT, let's say if your EBIT is zero, or if the EBIT is, let's say, 5,000, or if the EBIT is, let's say, 10,000, or let's say the EBIT is 25,000. At 35,000, let's say EBIT is going to 40, 50, and 60,000. So for each of these EBITs, now tell me, if your EBIT is varying, is your interest component going to vary? Of course, no. So interest is going to remain constant across all the plans. What about the PBT? The PBT will be definitely a different figure, because If EBIT is like 0 and if you have interest of 10,000, PBT will become definitely a negative figure, right? And then what about the tax? We said that the tax is running at 40%. So when we are having a PBT of a negative figure, what we will observe is we are having a tax savings. And after giving effect of the tax, we can have the profit after tax figures as like this. I can actually work around with so many numbers is because I'm working on Excel and this will be easier, for interpretation analysis purpose. Okay, so we have the PAT figures as this, and then we have the preference dividend. Now, preference dividend needs to be paid. Suppose preference dividend need to pay irrespective of the profits, and you have, let's say, you are paying preference dividend out of it. And now, if you look at the net profit for equity shareholders, we have these numbers. So what we observe is when you are at this financial break-even point level, in which this is going to be 0, and all these EBITs are, essentially, less than financial break-even point. So EBIT less than financial break-even point is one area. And these three are the ones which is greater than financial break-even point. Okay, so here we have these three things, and this is one. So looking at this table, what we can make out easily rather is I want you to just concentrate on the net profit for equity shareholders numbers and the corresponding EBIT numbers. So you observe that as and when your EBIT moves up, your net profit for equity shareholders is reducing, but it is still in the negative zone. And as soon as it touches the financial break-even point, it is 0. After that, what you observe is it is in a positive zone. So what you observe is the EBIT is, if your EBIT is less than financial break-even point, then net profit for equity shareholders is 0. And if it is above that, then your net profit for equity shareholders is positive, right? So net profit for equity shareholders, we can say that this is negative. This is anyways the 0, and this is going to be positive, right? So if your financial break-even point, uh, if your EBIT is exceeding financial break-even point, then you are actually into a positive net profit for equity shareholders. If it is less, then you're into the negative net profit for equity shareholders. That's a simple conclusion that we can make. And I would like to just make it a more, what you say as more level of, I will just try to, yeah, I'll make it more intuitive, more easy to grasp by way of graph. Um, I'll just draw a graph for both of them. So we have this level of EBIT basically available for us. And we have this net profit for equity shares also. Now, if I just go ahead and also calculate, apart from this net profit for equity shareholders, if you look at the EPS figures also, the EPS figures will be negative on this side and positive on the other side. Let's just draw diagram for this, for your intuitive understanding. So let's say I'm looking of second. Insert recommended chart. Yeah, look at this chart. Look at this net profit for equity shareholders line, right? So this is touching over here 0. So this point where my cursor currently placed, that is actually your financial break-even point, right? So this is the point. This is a point where we have the financial break-even point as 0, or it is the level of EBIT where you find your EPS or net profit for equity shareholders to be 0. Before this, it's in the negative zone, and after this, it's going into the positive zone. Right? I hope you're able to understand it in a better sense. Now, one more thing before I wind up this concept is, sir, how do we go about computing this financial break-even point? How do we calculate this break-even point? There's a very simple formula, but I would like to derive that formula for you guys. I'm going to derive that formula. Let's say I'll just take this thing. I'll just copy it downside. Yeah. So we want the level of EBIT where my net profit for equity shareholders should be 0. So if my net profit for equity shareholders is going to be 0, and my preference dividend is going to be minus preference dividend. So if you go up, can I say PAT is going to be how much? If the preference dividend is minus of preference dividend, my PAT is going to be, or rather, if I say my preference dividend is X amount, if my preference dividend is X amount, what will be the preference? What will be the PAT amount? PAT amount will be the same X figure, right? Because if your PAT is X, from that you would be subtracting X as a preference dividend, you would be getting the net profit for equity shareholders as 0. Then tax at the rate of 40%, let's say whatever be the tax rate. So let me take it as just tax at T, or tax at T%, or let's just a T rate, right? So the tax rate, and then we have the PBT. So essentially, what we do is if our PBT is 1, and if you're paying a tax of T, right? Yeah. So PAT figure will be 1 minus T, right? So if your PBT is 1, tax rate is T, and their PAT is 1 minus T, we can simply do the cross multiplication, and we can get the PBT figure as X multiplied by 1 divided by 1 minus T. So X divided by 1 minus T. And once we get this PBT, And we got this by simple cross multiplication. Okay. Now the interest amount, let me take that interest amount as y. Of course, we'll be subtracting the interest amount y to get the PBT. So what will be the EBIT figure, the reverse calculation, the backward calculation? You just need to add it up, and your EBIT by that backward calculation will be essentially x divided by 1 minus t and add up with y. So essentially, uh, what I can say is it's a financial break-even point where you have your net profit for equity shares as zero. That is going to be the break, that's the EBIT at which your net profit for equity shareholders is zero. So if we apply this simple formula, we get X. What was X, by the way? X was the preference dividend. So preference dividend upon 1 minus T plus the amount of interest, right? And if you just compare, if you just apply the formula over here where the interest was 10,000 and preference dividend was 15,000. So let's have a look how does it appear to be. Problem. Okay, yeah. If I apply that formula over here for the given question, we have the preference dividend of 15,000. So 15,000 divided by 1 minus 0.4 plus interest of 10,000. Okay, so if you just solve it, you can get the answer as 15 upon 0.6 as 25 and 10. So that's like 35,000. And that's exactly what was the break-even point in the question, in the example that we are looking at. So I've derived this financial break-even point formula. If you wish to remember the derivation, that's fine. If you don't look at it, you can just simply by heart this financial break-even point formula, right? Let me look at some queries that we have. No profit, no loss. Okay, the point at which total cost exactly equal to Manisha is asking. Tax is also determinant of financial break-even point. Yes, Darshan, definitely, because we have considered that. As there is no profit, so tax should be zero. Himanshu, if there is no profit, our assumption is you will get some tax benefit out of it. Okay, so you'll get the tax benefit, or you can use the loss to be setting it off, right? What's the benefit of maintaining EPS of zero? Why is capital structure the financial optimum, sir? Darshan, I'm not saying that capital structure at financial break-even point is optimum. Rather, what I'm saying is this is how you compute the financial break-even point. Rather, when you're raising any funds, you should look at what is the level of EBIT, or this your EBIT level should be greater than your financial break-even point. Okay. Why do you divide by preference by 1 minus T? Well, Shubham, if we take the preference profit before tax as 1, on that, if you pay tax, your PAT is 1 minus T. So we had the PAT as X. So we simply did a cross multiplication and we got this as X divided by 1 minus T. So it is X into 1 divided by 1 minus T. Okay, perfect. So let's take a break, guys. Let's take a break of 10 minutes. And after that, we'll take up the next concept and some more similar questions. Let's take a break right now, guys. Welcome back, guys. After the break, right now, we have seen how do we compute the financial break-even point. The formula goes as preference dividend upon 1 minus T plus the interest component. Now, let me just apply this break-even point concept in one of the questions, and let's just take it forward. So let's look at question number 6 right now. Let's look at question number 6, guys. Hypothetical Limited is in need of 1 lakh to finance its increasing net working capital requirement. The finance manager of the company believes that its various finance costs and share price will be unaffected by the selection of the particular plan since a small sum is involved. So debenture cost is 10%, preference share is 11%, equity shares will be sold at rupees 25 per share, and tax rate is 35%. We've got 3 plans to raise the funds, and we have to determine the financial break-even and which plan has a greater risk. So for this, I'll give you just guys, a 3 minute to get the break-even point for each of these 3 plans. Okay, so I'll give you 3 minutes to calculate the break-even point for all the 3 plans. You have this question ready in front of you. I'll just bring a timer for the ease of your understanding. Okay, so let me get started with the timer. Okay, your time begins now. Calculate the indifference point, guys. Come on, quick. It's not indifference point, my bad. Calculate the break-even point for all the 3 plans. For all the 3 plans, calculate the break-even point. Yeah, begin, guys. Come on, guys. Quick. What is not visible? Want to see the formula? Formula is this. What can I say now? Look at it fully. Okay, see, we have the formula, the timer, and also the question. Calculate the break-even point for all the 3 plans, guys. Come on. Are we ready? Well, we are on the verge of closing. Yes, 3 minutes are done. Are we done? Or no? Not yet. Well, let us try it out. This is question number 6. Okay, so let's look at this question number 6. So we have got 3 financing plans. We have plan 1, plan 2, and plan 3. So for each of these plans, we have got 3 different things: equity, preference share capital at 11%, and debt at 10%. Okay, so equity plan is 1 lakh. Make it counting decimal. Yeah. The first plan is to raise it fully by way of equity. So you have the total capital employed, be a sum of all of them. Now, the second plan is to raise it by way of 30, 10, and 60. So 30, 10, and 60 means 30,000, 10,000, and 60,000, in which the total capital employed will be 1 lakh. In plan 3, it's 50, 20, and 30. So that's essentially 50,000, 20,000, 30,000. And here we have all the 3 things. So we have equity, preferential capital, and debt. We have the preference dividend. What will the amount of preference dividend? No, here it is going to be 0, definitely. In this case, the preference dividend will be 10,000 multiplied by 11%, and here it is 20,000 multiplied by 11%. And we also look at what will be the amount of interest. In this case, the interest will be 60,000 multiplied by 10%, and this as 3,000. The preference dividend and interest we have. Preference dividend 1100, 2,200, interest of 6,000 and 3,000. Now we can get the financial break-even point by using the very simple formula, right? So financial break-even point formula we had, which was interest plus preference dividend divided by 1 minus t, right? So we had this formula of interest plus preference dividend divided by 1 minus t. So over here, it is interest plus preference dividend divided by 1 minus, what's the tax rate? Tax rate is, how much is it? 35%. Yeah, tax rate is 35%. This is 1 minus 0.35. And if I just apply it across, the break-even point, financial break-even point works out to be 7692 and 6384.62. Are we getting this? 7692.31 and 6384. Yeah, perfect. Correct, guys. So that's the answer for financial break-even point with regards to this question number 6. Now, looking at this financial break-even point, if I ask you which plan is more risky and less risky, so if we talk of level of risk is uh, preference dividend and interest, financial break-even point is zero. So of course here there is no risk at all. Why plan two is having a bit of more risk for a simple reason. You need to have a EBIT of 7692. You need to have a EBIT of 7692.32 to make profit, because only after you start earning EBIT more than 7,700 approx, you start making profit. Otherwise, you are into the loss zone. So level of risk over here, it is the least. In case of second plan, it is having the highest level of risk. So we can say this is the most risky plan. And plan three is having moderate risk because as compared to the others, it is in between. So because the break-even point is between 0 and 7692. Okay, so that was about this concept of financial break-even point. Now let's go for the next concept called as the indifference point. Indifference point. Ever heard of this statement, guys? Indifference point. Have you heard of this statement? Indifference point. Tell me. Ever heard of this statement of indifference point? Yes or no? Have you ever heard of this indifference point? Yeah, guys, indifference point. No? Indifference point. You haven't heard of it? Okay. Let me just put up a case in front of you, and then we can talk of indifference point. So let's say we have a plan A and we have another plan B. So there will be EBIT. From that, you will reduce the interest. Then you will get profit before tax. From that, you will get the tax. You will reduce the tax. Then you get a profit after tax. From that, you reduce the preference dividend. Then you have net profit for equity shareholders divided by the number of equity shares. And then you have the EPS. So EBIT less interest, PBT, tax, PAT, net profit for equity shareholders, number of equity shares, and EPS. So plan A and B, both of them are going to different because see, whatever plan you have, your EBIT cannot change. So EBIT is going to remaining same. So basically, EBIT for both the plans is just going to be equal. Okay, so EBIT is going to be same. Now interest over here, interest will be like for both plan A and plan B, it's going to be different. So let's say in plan A, interest is 30 and plan B, it is 10,000. Okay. Okay, so we have this interest. Negative 10,000. Now, PBT will be definitely after subtracting interest from EBIT. We will have the tax. Now, suppose tax is at the rate of 50%, right? And then you get the PAT figure. So tax is simply your PBT, at 50%, and you have a PAT figure. So PAT will be after subtracting the tax. Let's say the preference dividend is different. Over here, we don't have any preference dividend. And in plan two, we have a preference dividend of 40,000. There's a preference dividend of 40,000. And then net profit for equity shares will be PAT minus preference dividend. Number of equity shares, let's say in first case it is 12,000 and in second case it is 10,000. Okay. So EPS will be then, number of net profit for equity shares divided by number of equity shares. Now we are talking of EBIT. We're talking of a level of EBIT at which earnings per share for both of them is going to be same. The level of EBIT at which earnings per share for both the plans is going to be same. So in a sense, we can say indifference point is what? It is that level of EBIT for both plans at which EPS will be same. So indifference point is what? You have to calculate some level of EBIT. You have to calculate some level of EBIT, at which both plans are going to give us the same level of EPS. So let's say EBIT is X for both the plans. Let us say EBIT is X for both the plans. So if my EBIT is X, can you tell me what will be the amount of profit before tax? Because from EBIT, I need to reduce the interest. So profit before tax is going to be X minus 30,000, right? Or in the second case, it's going to be X minus 10,000. Okay. Then we have the tax rate. Tax rate, the tax is, since it is 50%, so applying the tax of 50%, it will be 0.5x minus 15,000, correct? And here it is going to be 0.5x minus 5,000. So you have the PAT also as 0.5x minus 15,000. Over here also the PAT is 0.5x minus 5,000. No preference dividend in this case. However, we have the preference dividend in the second case. Net profit for equity shareholders is going to be same as this figure. Whereas over here, since it's a preference dividend, my net profit for equity shareholders will be 0.5x minus 45,000. And then the EPS figure, we know that EPS is going to be just like this. Yeah. So under the first plan, EPS is 0.5x minus 15,000 upon 12,000. Under the second plan, it is going to be 0.5x minus 45,000 divided by 10,000. So I want the level of EBIT. I want this value of X, wherein my EPS for both plans is going to be same. Wherein the EPS of both plan is going to be same. So I give you the task, guys. It's a task for you, wherein this has to be equated, and within next probably, let's keep a timer again for this. Within probably next 3 minutes, I want the value of X from this, because that is the EBIT which I have assumed, which will make our EPS as equal. So what is that value of X at which your EPS is going to be equal? Try to calculate. Try to calculate the value of X, guys. Come on. Try to get the value of X by equating both the terms. Yep. Come on, guys. Okay. What's the value of x? Value of x. Just few seconds short of 3 minutes, guys. Yeah, got it. Okay, perfect. Now this time you have cracked it within the requisite time. True, it's x is 3,90,000. Perfect. X is 3,90,000. 3,90,000, right? It's a simple way of solving it. It's a normal equation with by which it is being solved. So if I just try to portray how it is being solved in a pen paper mode, let's say it's yeah. So 0.5x minus 15,000 upon 12,000 is equal to 0.5x minus 45,000 upon 10,000. If you have to solve it, I need to do the cross multiplication. So on doing that cross multiplication, but rather in spite of doing that cross multiplication, we can simply cancel the zeros and also call it as 6 and 5. So it further goes as 2.5x minus 15 into 5, which is 75,000 is equal to 3x minus 45,000 into 6, which is 2,70,000. Okay, so we have this 2,70,000 minus 75,000 is equal to 0.5x. So 2,70,000 minus 75,000, that's what 1,95,000 is equal to 0.5x, and x will be 3,90,000. So we get this uh, x value as 3,90,000. So essentially, we're saying that if our level of EBIT is 3,90,000, then both the plans are going to provide us the same level of EPS, right? Let's just try to test it out. Let's try to work it out with 3,90,000. If I take this 3,90,000 interest goes as interest and preference dividend is going to be the same. What is going to be different is even the number of shares are going to be the same. So preference dividend is also same, and this is 40,000, right? So now profit before tax, this will be just EBIT less interest. Then you have a tax which is at the rate of 30%. This in sorry 50%. We have this 50% tax rate, right? 50% tax rate, and then the PAT is 3,60,000 plus this net profit for equity shareholders will be PAT less the preference dividend. Right, and then you just divide this by the number of shares. Boom. That's the same as EPS. So you get both EPS at 15 rupees, right? You get both the EPS at 15 rupees. Correct, guys? So it is the level of EBIT. So 3,90,000 is the level of EBIT at which EPS for both the plants is same, which is 15. I hope you're getting it right. Perfect. Okay, so this is just an example to understand how and what is the indifference point. That's about indifference point. So how do we compute the indifference point? By the way, indifference point can be computed by taking the EBIT level as X and equate the level of EPS, right? Now, here I'll just put up a formula to compute EPS for any plan. How do we go about computing EPS for any plan? What could be a simple formula for that? We can compute the EPS of any plan by very easily. Let's take that EPS as rupees X. Okay, let's take that EPS as rupees X. From that X, we know we subtract the amount of interest. So this essentially becomes the profit before tax. From this, we know we subtract the tax and also we subtract the preference dividend, and then we divide this by number of equity shares, right? I'm just making it a bit more formal, and that's like X minus interest minus. How do we get the tax amount? Well, the tax amount is the tax rate T. The small t stands for tax rate over here. Tax rate multiplied by profit before tax minus preference dividend upon number of equity shares, which is X minus interest minus tax into PBT will be X minus interest minus preference dividend divided by number of equity shares. So in a sense, you can actually take this X minus interest common outside. So X minus interest, this is 1 minus T minus preference dividend upon number of equity shares. This is going to be a accepted formula for EPS calculation. So remember this formula for EPS calculation. We are going to have this EPS as X minus interest into 1 minus T minus preference dividend upon number of equity shares. Okay, got it? Got it, guys? True? Now, we have this EPS computation formula for us. Now, let's go for one of the questions let's say question number 11 is. Let's look at this question number 11. Question number 11. Let's read through it first, and then we can discuss about it. Key information pertaining to proposed new financing plans for hypothetical limited is given below. So we have plan 1 and plan 2. Two plans are given to us. 15,000 equity shares of 100 each. Second plan is to raise 30,000 equity shares of 100 each. Preference shares will be 12%, 25,000 shares of rupees 100 each. And debentures of 5 lakh at a coupon rate of 0.1, which is 10% rate of interest, and 15 lakh at a coupon rate of 11%. So let me just write down the capital structures. The capital structures, we have got two plans. Plan 1 and plan 2. We have the equity, preference share capital, and debentures. So equity, that's going to be like 15,000 into 100, and that's going to be 30,000 into 100. The currency is decimals, yeah. Preference share capital 25,000, 100, and here it is 0. For debentures, we have 5 lakh, plan 1, and in plan 2, it is 15 lakh. If we look at the total capital employed, that is actually summation of all these three, 45 lakh. Total capital employed is 45 lakhs. Now, we have to compute EBIT, EPS coordinates, indifference point, financial break-even point. A lot of things is to be done about that. Now, right now, let's just perform two basic calculations over here. That is, let's obtain the break-even point for each financing plan and also look at the indifference point. So first talk of the indifference point. First talking of the break-even point. Okay, so break-even point. By the way, this preference share capital, it is at the rate of 12%, and debentures is at the rate of 10% and 11%. Right, so break-even point is to be computed. So break-even point, we know as per the formula, break-even point is computed as interest plus preference dividend divided by 1 minus the tax rate. Over here, break-even point will be to compute the interest and also the preference dividend. So let's talk of interest and preference dividend. So interest will be like 5,000 multiplied by 10%. Right, and over here it is 15 lakh multiplied by 11%, which is 1 lakh. 65,000 is the interest. And preference dividend, here it is 25 lakh multiplied by 12%, and here it is no preference. Now, the break-even point, going by this formula, we have the interest plus preference dividend divided by 1 minus tax rate. Tax rate is 35%. So 5 lakh. We have the indifference points ready over here, which is 5,11,538 and 1,65,000. Of course, with regards to risk, we can say this is more risky and this is less risky, because lower the break-even point, the earlier you will be able to make the profits. Because higher break-even point, it means you need to earn a higher level of EBIT to start making profits for your shareholders. So therefore, we say that plan one is more risky, plan two is less risky. Now, I want you to get the indifference point. And for that indifference point, again, guys, we'll have to write down the level of EPS. We'll have to compute the EPS. So with regards to EPS, what will be this number? EPS will be X minus, interest of 50,000, X minus interest of 50,000 into 1 minus tax rate of 35%, 1 minus 0.35, right? 1 minus tax rate of 35%, minus preference dividend of 3 lakh. So X minus 50,000 minus 1 into 1 minus 0.35 minus 3 lakh divided by the number of shares over here. It will be 15,000. That's given in the question itself. And this being equal to the other side's EPS will be what? X minus the interest is 1,65,000. 1,65,000 into 1 minus 0.35, which is 1 minus the tax rate. There's no preference dividend over here. And then we divide this by 10,000 shares. Right? So you can get the value of X by simply equating both of them. And I want you to solve it or get the value of this X within next 3 minutes. So I put up a timer for you. Get the value of X, guys. Come on. Get the value of X for this two financial plans. Because the X that you're going to get, that's your indifference point. Yeah. Get the value of X. Yeah. Halfway through, guys. Come on, quick. Get the value of X. One minute to go, guys. Give me the value of X at which your EPS is same. Half a minute left, guys. Come on, quick. What's the level of EB8 at which both the plans are having same EPS? The value of X. Time is up, guys. Anyone got it? Anyone got it? 663280. Seems to be some incorrectness in your answers. Let me just quickly solve it for you. Just solve it for you quickly. Well, it should be like X minus 50,000 into 0.65 minus 3 lakh divided by 15,000 is equal to X minus 1,65,000 into 0.65 divided by 10,000. So you can actually cancel out these two items. This is 2 and this is 3. So X minus 50,000 into 0.65. So that will be like 0.65X minus 50,000 into 0.65. That's basically 30,500. Yeah. Minus 3 lakh divided by 3 is equal to 0.65X minus 1,65,000 into 0.65, which is 107,250 divided by 2. When you do the cross multiplication, you can actually get it as cross multiplying it, we get it as 1.3x minus 332. So that into 2 will be 6,65,000 is equal to 0.65 into 3. Some problem, I think it's my bad, guys, because the number of shares should be, 30,000. Should be 30,000. It should be just 2, and this is 1. So 1.3x minus 6,65,000 is equal to 0.65x minus 107,250. And then solving it, you will get the value of x to be 858076. 858076. Yeah, this is the level of EBIT, at which both the plans are going to have the same EPS. Yeah, so let's just try to compute some chart based on this. So let's say EBIT, and then we'll say EPS of plan 1 and EPS of plan. So EBIT, since it is 8,58,076, let me take it somewhere over here. 8,58,076 is the indifference point, right? Let's take also EBIT lower than this. Lower than this. So let me take EBIT as maybe just 10 lakh, maybe another 30 lakh. No, 30 lakh, it's 3 lakh. then maybe it is 5 lakh, then 7 lakh, 8 lakh, and then you have this 10 lakh, 12 lakh, and 14 lakh. So EPS is going to be, as we have set up this formula, that's going to be EBIT minus any interest. So plan one, we have the interest as 50,000. So plan one is minus 50,000. This becomes PBT. This multiplied by 0.65 because 35% is the tax rate. And from that, we reduce the preference dividend, which is 3 lakh. Right? And then the whole this thing divided by the number of shares that we have is 15,000. We get these as the EPS count or EPS for each one of them. And similarly, we can get the EPS figures also. This is I'm calculating it with the help of quick Excel formula, guys, just for the ease of understanding the concept rather than focusing on the numbers, rather than focusing on how to calculate. I'm just focusing on the concept right now. So EPS for plan 2 will be accordingly similar lines. We have EBIT less interest of 1,65,000 and this multiplied by 0.65 divided by the number of shares as 30,000. Yeah, so here we get this as the so here we get this as a EBIT and EPS figures. So at multiple levels of EBIT, when your EBIT is 1 lakh, then EPS for plan 1 is this and EPS for plan 2 is this. What you observe is at 8,58,076, you see that EPS is same for both plans. Now to visually just make it more presentable and for easy analysis, let me just draw a chart for you. Yeah, look at this chart, guys. Look at this chart. There is one point that we have, which is intersecting, which is this point, So that is our indifference point. And what you prefer to say is, when your EBIT level is below this indifference point, plan 2 is dominating. Whereas in case of the blue line, that is a plan 1, that dominates after the indifference point. So before indifference point, plan 1 is better. And after indifference point, so before indifference point, plan 2 is better. After indifference point, plan 1 is better. So if I say EBIT less than indifference. So EBIT is less than indifference point. Plan 2 is preferred. And if your EBIT is greater than indifference point, plan 1 is preferred. Okay, so plan 2, was it a risky plan or was it a less risky plan? Was it a risky plan? Plan 2, was it a risky plan or not so risky plan? See, plan 2 was less risky. Plan 1 was more risky. So when your EBIT is less than indifference point, you can say over here, less risky plan. is preferred. Okay. And when your EBIT is greater than indifference point, then more risky plan is going to be preferred. So indifference point is actually a cutoff between the risky plan and the non-risky plan. So when your anticipated level of EBIT is less than the indifference point, you will prefer to go for less risky plan. Whereas if it is your anticipated level of EBIT is more than the indifference point, then you will prefer plan one, which is going to be more risky, right? So that's the whole point of this indifference point, where more than indifference point, risky plan is preferred, less than indifference point, lesser risky plan is preferred. Okay, so that's what we intended to study in this today's session of capital structure. We have learned three things. One is how to decide which plan is to be chosen. Second is how to compute the break-even point and how to decide based on break-even which plan is risky and less risky. Third is to decide which plan is to be preferred based on indifference point. Indifference point is the level of EBIT at which EPS is going to be constant, or EPS is going to be same for both the plans, right? So that's what we intended to work on this. Now we'll stop here for the day. We'll take up the next portion in this, which is capital structure theories in the next class, guys. So till that time, bye bye and take care.